Welcome to Business Incorporated. Thank you for joining us. I am Bolaji Akinwale. This week on the program, we'll take a look at the Pension Reform Act of 2004, looking at the pensions market in general, and the plans by the government to establish a new bill to reflect changes that it is making at the moment. To let us into this development is Dave Uduanu. He is the chairman of the Pension Fund Operators Association of Nigeria. In this interview with Harriet Agbenyi, Dave Uduanu explains the importance of improving on the current acts. But before we bring on Dave, we will check on the headlines for the week. The International Monetary Fund has predicted that Nigeria will face political and economic risks if the security problems in the northern parts of the country are not urgently controlled by the federal government and security agencies. In this last staff report that was presented in Washington, D.C., United States on Wednesday, the lender stated that insecurity was a threat to the country's anticipated strong growth to be driven by agriculture, trade and services. Killings by Boko Haram insurgents in the northeast, as well as attacks on communities by Fulani herdsmen and unknown gunmen in other parts of the north have increased lately, even as fears are mounting over possible violence in the run-up to the 2015 general elections. The IMF report stated the growth is expected to remain strong, driven by agriculture, trade and services. Inflation should continue to decline in line with a tight monetary policy and a lowering trend in food prices from higher rice and wheat production. Key downside risks are persistently lower oil revenue from changing global dynamics and lower domestic production, less prudent fiscal policy through the ongoing political cycle, ongoing security problems in the north, and uncertainty about the pace of global recovery. In the summary of the report, which was posted on its website, the IMF stated, despite recent strong non-oil growth, poverty and income inequality remain high, and social and governance indicators are below averages for sub-Saharan Africa. Structural reforms under the transformation agenda are ongoing, but significant infrastructure gaps and weak institutional capacity still retard growth prospects. The Central Bank of Nigeria has published its exposure draft guidelines for licensing and regulation of financial holding companies in Nigeria, calling for comments by industry stakeholders ahead of its having a binding effect. Such input must be received by May the 9th, deadline for the submission either in hard or soft copies. As part of the draft guideline, the Apex Bank is proposing that subsidiaries or other partners must not acquire shares of the parent company financial holding or sister firms within the group. This proposal is coming nearly 4 years after Lamidi Sanusi, as the Apex Bank governor, overturned the universal banking policy of his immediate predecessor, Professor Chukwuma Soludo, citing abuse of the policy. Those banking groups who still desire to keep non-prohibited subsidiaries were allowed to ring-fence the banks and then accommodate others in a financial holding company. As part of ensuring proper regulation of companies within the OldCo by the board, the Apex Bank in the guideline plans to excise a banking subsidiary from a financial holding company group and ring-fence it into a monoline bank where, in the opinion of the central bank, the financial holding company is being run in an unprofessional manner that is detrimental to the interests of depositors and all other stakeholders of the banking subsidiary. According to the draft guideline, financial holdcos shall comply with the provisions of any code of corporate governance issued by the central bank for institutions under its purview and demonstrate evidence of the existence of competent and independent board with capacity to provide oversight or internal controls and risk management practices. They must also comply with the provisions of the Securities and Exchange Commission Code of Corporate Governance for public companies and listed entities in Nigeria. Stanbic IBTC Holdings has been able to record double-digit earnings growth in its top and bottom line. For the 3-month period through March 2014, Stanbic IBTC grew gross earnings by 13.7% to 30.22 billion naira from 26.58 billion naira in the same period of the prior year. Profit before tax in the review surged by 89.24% to 8.97 billion naira compared with 4.74 billion in the first quarter of 2013. Profit after tax followed the same positive trajectory as it spiked by 93% to 6.89 billion naira in 2014 from 3.57 billion naira in 2013. And based on the analysis of first quarter 2014 financial results of Tier 1 banks, the above figures is the most impressive.
Don't be left in the dark. Be the first to know. Get the latest news and developing stories anytime, anywhere, on your mobile device. Log on to m.channelstv.com and click on the Channels TV logo. Channels Television, the news at your fingertips.
The Pension Act was passed into law in 2004. We've operated the Act for 6 years now, and a lot of things have changed. And when it was passed into law in 2004, it was novel and nobody had experience with pensions, contributory pensions. Having had the benefit of 6 years of operation, we thought it's time to review certain sections of the Act to bring it in line with current realities, to expand the coverage of the industry, and to widen the scope of coverage, and to increase the impact of pension funds in the economy. I mean, that's the overall objective of the reform. The other true important aspect is to institutionalize PENCOM a bit more, and also to ensure that exemptions from the scheme within the ambit of the law. For the public sector workers, before now they had a final salary scheme, which was the old defined benefit scheme. That scheme is made up of two components. One is a gratuity, which is paid when the worker stops working, and then a pension that is equivalent, almost equal to the final salaries of the employee. Now, the PRA 2004 sort of abolished gratuity for the public sector workers, and one. Number two, the rates, the pension that we pay when compared to the old scheme was not exactly the same. So there has been agitation by employees to have their pensions increased to a higher level. Our recommendation, our thoughts are simple: keep the 15% for private sector employers. Have a dialogue with government to increase the contribution rate from 15 to 20%. Now, that increase in contribution rate is a decision that government will have to take. This is just a proposal in the Act. So that's what we're saying, that keep the 15% for private sector and look at the possibility of increasing the contribution rate for government to 20%. But there's another way around it. The other way around it is what we're also looking at, the minimum pension guarantee. Because if people are complaining of the pension levels, another way to deal with it is to institute a minimum pension, so that when you retire, regardless of how much you have, you can get a minimum pension. That will be funded through mechanisms, either through government contribution and also from some contributions from the industry.
So what other pertinent issues are being proposed in this amendment?
Well, apart from the contribution rates, there are other key things that are of even more concern to us. One is application of the Act. I'll run through them and explain. Application of the Act is one of them. The other one is exemption of some categories of employees from the Act. The other one is custody of annuity funds with pension fund custodian. I think the last one, which is major, is we want to restrict the establishment of new closed pension fund administrators, particularly for the public sector. Now let me just run through them very quickly. The application of the act, we're saying that the act should be applied to employers with staff of 3 and above. So reduce the number of employees required to be covered by the act from 5 to 3, which means that a lot more companies and entities will be covered by the act, particularly the informal sector. Yes, so we also want to see the act being applied to the informal sector. Right now, the way the act is worded, it doesn't cover the informal sector. The informal sector can contribute on a voluntary basis. Now, whilst we're not going to make it compulsory for the informal sector, we want to amend the act in a manner that allows the private sector workers, informal sector workers, to be part of it. And essentially, it is to allow every individual to open a personal pension account without linking it to an employer. Because right now, for you to have a pension account, you have to be working for an employer that is registered either by the CAC or by company or any other form of registration.
So that's what the act is actually going to be.
That's what, but I'm saying the other things that even they might not be in the act, but we want to include in the act to allow the application to cover employers with staff of 3 and above, and also for the informal sector. So we don't want every Nigerian. I think the point is that pension is almost like human rights. You can't. I don't know why people think that they can live without having a pension. The informal pension arrangement in Africa has broken down. The extended family system is not working. So there's no way you can even be walking around without pension. I mean, you're not thinking of the future.
And I guess to be worthy to collect a pension, you have to be a worker. Or doesn't it necessarily follow?
Well, you have to be, and it's a definition of who is a worker. You have to be economically active to collect a pension. So I mean, some of the people that work for themselves make a lot more money than people that work for either government or private sector, but they have no pension arrangement. So you could see a successful businessman today, tomorrow, he's in his 60s, he's no longer able to work. He goes into abject poverty. I've seen that happen time and time again. We have experience of that in our various villages. You see a man who was successful, and when he retires, he falls back to nothing, and he goes back to the village and he's suffering because he has no pension. And let me also make the point that people think that their house is their pension. Your house cannot be your pension, because your pension is something that gives you regular income on a monthly basis. So it's not an asset that you hope to sell to collect an income. It's an arrangement that the income is guaranteed to come to you